From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, markets whipsawed by conflict in Ukraine, global leaders avoiding energy sanctions, and the Fed staying on track to hike. We begin with the big issue, geopolitics clouding the path forward.
You've got three different plots playing here.
We've seen in this escalation
how much of an economic impact there will be.
And three is the market reaction.
Given the uncertainty,
They are on different planets.
What Wall Street is generally having a very difficult time getting their head around is what is the Fed's priority?
They're trying to thread the needle.
They don't have a thread the needle option.
they're already facing a dilemma.
Now we have this invasion.
And this has just simply increased that dilemma.
It just makes it a really difficult backdrop for central bankers.
There's not a lot of control on the narrative.
They've only got trade-offs.
Nobody knows how this is going to play out.
Joining us now through the next 30 minutes, BlackRock's Marilyn Watson, Invesco's Brill, and Sankaran of Morgan Stanley. Marilyn, let's start here. What changed this week for you?
Well, so really, obviously, we had our worst case scenario in terms of the on-the-ground invasion in Ukraine, and then looking at the response from the US and allies in terms of sanctions. I think what was really critical that we saw the market being whipsawed around in terms of potential sanctions, and then obviously energy being sort of left off the table. Also, there's been a huge amount of discussion around SWIFT and other sanctions. But I think at the moment, the market, we saw it. The equity market really sell off. We saw, a real sort of circular movement in the bond market. We saw, a real increase now in inflation expectations, which is being priced into the front end of the curve as well. So I think we're seeing, a huge amount in terms of geopolitics, inflation, and the reaction of the US, the EU, and other allies as well.
Well, let's talk about the reaction, Matt. One thing you've got to ask yourself this week, are Western leaders willing to compromise their own countries, their own economies, in order to compromise the economy of Russia and the president's leadership? And when you hear lines like this, we're not going to do anything which causes an unintended disruption to the flow of energy from the US administration, you could conclude, Matt, that they're not willing to go that far. So can you also conclude that the fundamentals this week, even though everything you see on the screens is deeply saddening, that the fundamentals for the US economy hasn't changed that much?
Yeah, Jonathan, I think, obviously you got to separate the humanitarian part of it out first. But when you just talk about the markets, what changed this week? Well, valuations changed. Fundamentals didn't change. Valuations changed this week. And I'm actually pretty bullish now. I went from being very, very bearish to being relatively bullish. There's still a lot of risks on the horizon, but valuations corrected this week quite quickly. We thought we would take until late March, early April to get to these spread levels that we got to this week. And all of a sudden, this just accelerated things. So in that regard, when you take a step back, I think this is an attractive entry point in the U.S. because fundamentals have not changed because of the way that the sanctions were aligned and laid out, and valuations have adjusted. So it's a weird way to say it, but it's actually a pretty decent opportunity, I think, right now.
Where specifically, Matt, are you looking?
So energy is a great opportunity. Energy, what has been so unique about this move in the markets is if you look at credit spreads, particularly of energy names, they have done basically in line with everything else, which is bad. They've done terrible. Everything's done terrible. You look at some of the best quality companies like a ConocoPhillips that issued within the last week. Their credit spreads are 50 to 75 basis points wider, and they're printing money. So in that regard, you could argue that what's happening with Russia and Ukraine is good for the U.S. energy sector. So to me, that you have to get by the beta, and the beta right now is just so correlated. But once you get by the beta, there's huge opportunities within energy. You look at numbers out of Occidental this week. High yield energy is really a great place to be. We're going to see upgrades there. So for me, you just got to power through this kind of transitionary period, and then energy looks like an extremely attractive way to play the market.
Sankaran, your take.
Yeah, I would agree with most of what Matt said, right? Obviously the humanitarian side of it is deeply concerning. But if you think about it from the market's perspective, one, there is more growth uncertainty, but it does feel like some of the kind of outsized moves that you would expect or outsized negative impacts that you'd expect, those are beginning to be priced out. And that's also true for the Fed's reaction function, which means that you're left with valuations which are looking much more reasonable now. And particularly from the perspective of the credit markets, it's been more of a valuation problem that the credit market has been dealing with for some time now. That looks much more interesting. And I do agree with Matt that these are probably setting us up for more interesting entry points now.
Can I get some more clarity on that as well, Sri, from you? You mentioned the Fed's reaction function. Do you have clarity on that?
No. I mean, what I'm trying to get at is like some of the kind of extreme scenarios that the market was upping the ante with respect to saying that, well, it's going to go from 6 to 7 to 9 rate hikes, et cetera. I think some of those scenarios, that debate has probably softened a little bit, but because you would expect them to be a bit more defensive, not push too hard with respect to the compromise on the growth narrative, because there is a fair amount of incremental uncertainty that's come through. And my point was that the debate around the 50 basis point rate hike and some of the extreme scenarios in terms of the magnitude of the rate hikes, at least for the near term, that seems to have abated a little bit. And that's kind of what I was talking about.
Well, that's the key here, isn't it, Sri? It's the near term versus, say, the medium to long term. And Marilyn, I'd love your thoughts on that. In the near term, for some people, I think it's taken the 50 basis point call away. For the likes of Governor Waller thinks it's still on the table. He said the following: my preference is to increase the target range 100 basis points by the middle of this year. If inflation indicates that the economy is still running exceedingly hot, a strong case can be made for a 50 basis point move in March. We'll hear from Chairman Powell next week. We'll have another inflation print on March 10th. Marilyn, we've got a bigger energy story, potentially a second shock. When you work through that, does this make the Fed go quicker, more slowly? I've heard arguments that go both ways.
Yeah, that's right. And I think the key here is the inflation. And I think in terms of the path of and the overall trajectory of the Fed, then I don't think that changes. Maybe in terms of timing, in terms of pace, it may change slightly. And it looks like the 50 basis point hike next month has been effectively taken off the table, and I think we are more likely to see maybe a slightly more cautious, introduction to rate hikes. That being said, as I say, I mean, Waller's comments, I think, really do highlight again the fact that we are seeing high inflation in the US. We do have strong underlying fundamentals, looking at the maximum employment and the other aspects of activity in the US. And so I think the overall trajectory, as I say, I do think will remain on track, and they are going to continue to normalize. But perhaps just in the very, very short term, there is a little bit more uncertainty. And so I do think perhaps the Fed will be a little bit slower than maybe the market was previously anticipating.
Marilyn, do you think it would also slow down the ECB perhaps more, and therefore, because of that, complicate the Fed's ability to go quicker?
So I think in terms of the ECB, we've also heard a lot of comments coming out of Austria and elsewhere that maybe they will also potentially slow or delay any changes to the normalization and ending their asset purchases. However, I think the ECB is already far behind the Fed anyway in terms of normalization. So I think certainly in the short term, I don't think it really changes that differential. I don't think it changes the Fed's trajectory, certainly in the short term. Maybe sort of in the medium term, further down the line, depending on the impact of the overall European economy from tensions in the Ukraine and the issues that we're seeing at the moment in terms of the impact of sanctions and developments that are yet to unfold. It is possible that we could see an impact from the ECB on the Fed, but much further down the line. I certainly think in the short term, the Fed is still on track to start raising rates, is still on track to quantitative tighten, and I think the ECB is just still behind them anyway in terms of normalization.
And Matt, it's been fascinating to follow the bond market in Germany too. We opened up this week at 20 basis points on 10s in Germany, right now 23. Now, Matt, if I'd explained to you what this week would look like in Eastern Europe, would you have guessed that we'd only be basically flat on a German 10-year yield this week?
Yeah, it's basically unimaginable. You could have left for the week and missed nothing in terms of the markets right over there, but at least from a government standpoint. I think the Fed or the ECB is in an equally as tough spot as the Fed is, and this is not what any of them needed from a central bank standpoint. But if you look at the ECB, I think this slows them down. This is really going to be a negative for the overall economy of the Eurozone. For the Fed and for the U.S., it's more of just a near-term inflationary shock. If you're the Fed, I think what this has changed is the fact that we were in this vortex or this cycle where everybody was one-upping each other of how many times the Fed was going to hike in 2022. And we went from 4 to 6 to 7. And then all of a sudden, I think we've broken that cycle now. So I think we've finally gotten to a point where everything's sort of priced in, the market's sort of ready for it. And I don't think you're going to get people coming out with 8, 9, 10 hikes. Now maybe I could be wrong, but I think that takes that kind of tail risk off the table. So that is finally a point where we can say maybe the worst has been priced in here. And over in the ECB, they never got that aggressive over there. But just even the thought of them hiking rates late in 2022 really spooked the market. And I think that's now off the table as well.
Sri, that's basically your point, isn't it? That it takes away that big tail risk, that they have to go quicker, bigger, do more.
Yeah, and specifically on the point of the ECB, I would actually argue that the balancing act there is probably going to be a bit more difficult because, as Marilyn was pointing out, they are a bit behind the Fed with respect to where they are in the policy cycle. But what's also more interesting is the response that the BTP bond spread had on Wednesday and Thursday. And that, to me, is where their response function would be slightly different because they are going to be much more sensitive to what's happening to the peripheral spread. Because if they let that get out of control, then it has ramifications for the broader credit market. It takes us back to square one in terms of what they were trying to solve for before all the COVID-related crisis and the programs put in place.
Sri Sankaran, sticking with us alongside Marilyn Watson and Matt Brill. Coming up on the programme, up next, the auction block. Borrowers moving to the sidelines after Russia invades Ukraine. That conversation up next. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off in Europe with geopolitical tensions leading to the slowest week of the year. Issuance falling short of 17 billion euros after a number of deals were put on ice. In the US, high-grade bond sales hitting $18 billion, short of weekly estimates. 16 companies coming to market, with the largest offering coming from Wells Fargo. And the US junk bond market grinding to a halt after pricing a little more than $9 billion this month, the slowest February since 2016. Caught up with PGIM's Greg Peters a little bit earlier this morning. Take a listen to what he had to say about maybe a market that's not well priced.
There's good news, bad news story. The bad news is that I do think the beta in the market, that valuations still have a way to go, but the dislocations are really becoming quite pronounced. And so what we're doing is relative value. We're really evaluating those relationships, but definitely not diving into the pool here. I think this is a volatile time, and we haven't really seen the repricing.
Marilyn, Greg's making 2 points here, so let's pick up on a couple of them. Point one is that we haven't had the big shakeout. Point two is that there is this comfort, not in liftoff for the Fed or the pace of Fed hikes, but the ultimate endpoint, the destination, that it will be low and comfortable for investors. Can we pick up on point two first, Marilyn? This idea that the Fed won't have to go that far, take rates that high, that it would disrupt this economy, this market too much.
Yeah, I think that's right. I mean, the market is definitely still expecting that the end point of this normalization will be much lower than in previous cycles. There are risks around that, and I think that's a key point, is in terms of inflation. When you look at the price of oil, if we were to see, for example, actually sanctions on energy, and you were to see the price of oil be much higher for an extended period of time, then that's going to feed through, obviously, far more significantly into overall inflation. We're still seeing a lot in terms of expectations for inflation around the transitory nature of it. We've obviously had the PCE data today, which still shows that inflation in the US is still very high and remains high. And while we do expect that to come down, there are some significant headwinds when you look at things such as the amount of housing stock that you have and the impact on rent and other things. We expect inflation to obviously come down, but to remain relatively sticky for a little bit longer. And if we do see the impact of energy on feeding through onto that further as well, then that could potentially impact the view that people have at the moment overall in the market, that the end point in terms of normalization will be lower. So I do think that's a key point to keep an eye on. And I do think that of all the Fed speakers that we've heard over the past 2 or 3 days, the data dependency and the real keen eye that we need to keep on inflation and on the nature and the core elements of inflation are really going to be key in terms of the trajectory of the Fed and normalization going forward.
Matt, the near-term call is the easy one. Working out the destination, I think, is the hard one. They don't know. One of the big stories earlier this week in the bond market was actually what happened in New Zealand. they actually had to take up the long rate and think about the end point, 250 out to 325. That was going to be where rates were going to end of 23. It was 250, they pushed it out to 325. Matt, can you imagine if the Fed had to do that on March 16th, how this market would respond if they had to take up that long dot, 75 basis points?
Yeah, fortunately, I don't think they're going to have to, because the market is somewhat telling you that long-term rates are not going to go up that much. I mean, you're looking at 2% on 10s right now, and it's been pretty well contained. But yeah, that would not be good for risk assets. I think that the market has gotten comfortable with this idea of a very, very swift move by the Fed. Call it 6, 7 hikes this year, 2, 3 next year, and then being done. Maybe have 1 or 2 more at most after that. So that gets you to 2, 2 1/4, and that's kind of it. I tend to believe that's the case. I'm seeing a lot of things out there that are proving to me that there's going to be a lot of technological innovation that's going to drive wages, unfortunately, but wages are going to be lower, or at least be contained in the future. But you're also going to just see just a lot of other input costs be impacted by improved technology costs. And that's what everybody's spending their money on right now, is combating that. So you give them 2 or 3 years to work on that. I think that'll flow through. The Fed just, at this point, I don't think they have to worry too much about runaway inflation. So what I'm seeing right now is just getting back to normal. And that's what everybody needs to do, is get back to normalized levels of everything. And to me, that's somewhere in that 1.5% to 2%. And I think that's what they're going to try to do. And then after that, I don't think we're going to have to take it much further. But if we do, yeah, that's very, very negative.
That's the hope. There's a big bet on that, Sri, that works out. I know that for you, loan investors have been shouting from the macro storm. That's your line. Is it time to lean the other way yet, Matt? Sri, rather? Are you there yet on that story?
Yeah, I think our view is still that we would prefer loans over high yield bonds just for now, because we're still very early in this whole hiking cycle. And that's where the debate around where the terminal rate is, how fast they go, et cetera. I mean, obviously that does matter, but there is going to be a tipping point with respect to the magnitude of rate hikes and the level of rates at which we will kind of switch our preferences. But for now, it does feel like it's still more of a duration problem rather than a credit fundamental problem. And for now, I think it's the right call would be to hold on to loans over high yield bonds.
Marilyn, do you agree?
So I think we do like loans at the moment. We also do like investment grade as well. And actually, I think now in this environment, all the topics we've been talking about in terms of technology that Matt mentioned, I think that's going to continue to be key, particularly when you do look at areas of technology that are going to work towards taking some of the higher costs out of problems such as the labour market and elsewhere. So that's one area. And I think also when you continue to look at, I think, very cash generative businesses, when you look at the liquidity in terms of some investment grade, I think that's also going to be key, especially in this current environment.
Marilyn Watson, Matt Brill, Sankaran sticking with us. Just some headlines I want to keep you up to speed on. The British Prime Minister, according to the Wall Street Journal, is ready to sanction Putin and Lavrov. Various reports from the FT earlier this morning. The Wall Street Journal has that story as well, seeing a lot of reports around that too. And the President of the United States, Joe Biden, did hold a secure call with the Ukrainian leader today for about 10 minutes, 40 minutes it seems actually, from 11:52 to 12:32 Eastern Time. Just some of the headlines on my screen at the moment. Still ahead, the final spread, the week ahead, featuring Chairman Powell and the payrolls report. That conversation is up next. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up, featuring President Biden's State of the Union address coming up on Tuesday. Some PMIs out of Europe, the US and China. We get Fed speak with Bostic, Evans and Bullard, plus Chairman Powell testifying before Congress on Wednesday and Thursday. And finally, closing out the week with the US payrolls report on Friday. Just to keep you up to speed on a very fast-moving story, the Ukrainian foreign minister out on Twitter just moments ago, saying his call with the Italian counterpart, full solidarity with Ukraine. His colleague assured me that Italy will support banning Russia from SWIFT. That story coming in the last 30 minutes or so. That effort's starting to build just a little bit more. Let's bring in the panel for some final thoughts. Marilyn Watson, Matt Brill, Srikanth. Can we start with next week? And Marilyn, what you're looking for from this chairman in that hearing?
Yeah, so I think we're really looking to hear if he mentions anything around, obviously, Ukraine, Russia sanctions, if that's going to have any sort of impact on Fed policy. We're also looking to hear anything he says at all about inflation and the trajectory of that. And obviously, because we have the Fed coming up in just a couple of weeks, then we're really looking to hear if he has any thoughts at all around the pace, the timing, and if he thinks that any of the issues over the last 2 weeks are going to impact the current trajectory that they're seeing.
Sri, what about you?
Yeah, I mean, I think if there is any meaningful discomfort with what the market is pricing in, I think that's the last opportunity that Powell has to express that. So to the extent that, I mean, they want to push back more aggressively against the initial rate hike of 50 basis points or kind of talk more about the magnitude of rate hikes, et cetera. I mean, any kind of indication with respect to where they are versus the market, that's probably the signal to watch out for. And the second element of it would just be the balance sheet side of it. I don't know if there's going to be any concrete comments, but definitely worth watching that for that as well.
Matt Brill?
Yeah, I mean, all of the above, and definitely the balance sheet would be something that I would love to hear a little bit more about. I think it's probably still going to be too early. So the biggest takeaway next week will be 50 or 25, and he can easily set the table for 50 basis points if he wants to. If I'm him, I take that opportunity and I price that into the market because it's just right on the cusp already. You might as well push it over to 50, in my opinion. So I think he'll likely do that next week.
Should we get 3 quick questions in? Just quickly, let's squeeze all this in. 3 quick questions, 3 quick answers, if we can. First of all, to you, Marilyn, 50 or 25 next month? 50 or 25? 50 or 25?
25.
Matt?
50.
Oh, interesting. Sri?
25.
25, 50, 25. Will the ECB hike before the year is out? Just a quick yes or no. Will the ECB get a hike in before the year is out right here in 22? Yes or no, Sri?
Yes.
Marilyn?
Oh, gosh, tough. Maybe yes.
Matt?
Tough.
No.
Final question. The low for the 10-year this year so far, just south of 150. Have we seen the low for the 10-year this year? Yes or no? Matt Brill?
100%.
Sri?
Yes.
Marilyn?
Yes.
To the 3 of you, thank you very much for being with us. To Marilyn Watson, Matt Brill and Sri Sankaran. From New York City, for our audience worldwide, that does it for us. We'll see you at the same time, the same place next week. This was Bloomberg Real Yield. This is Bloomberg TV.